Straight to the phones we go. We're talking to Mike in Edmonton. Hi, Mike.
Hi, Mark and David. My question is on Freeport, ticker FCX, out of New York. And I guess I've been a big fan of utilities and pipelines, and they've served me well, but I'm starting to question it because of how expensive they are. And shifting a bit more into commodity stocks like Freeport, it appears to be undervalued by about 25% or maybe even more. And as well, I got a very long time horizon, like I can hold on to a stock for 7 years plus. So I'm just would appreciate the comments on the strategy.
Okay, Mike. Is he too early into Freeport here?
So, Mike, my concern is this. We're in a deleveraging environment, which tends to be a little bit disinflationary. We've had lots of stimulus thrown at the market. We have not had the economic response that the policymakers would expect. We have become accustomed over the last 10 years that when the market rallies, the playbook is to go to high beta, economically sensitive stocks, especially here in Canada, because that's what's worked. I think at this point, there is little evidence that it is time to do that yet. Copper prices have not been responding. The share prices of the materials group have been performing poorly. And I'm not to say that as a value investor, someone might make a call that says it's cheap and that they have a very long time horizon. It's just that's not our strategy. We don't try and pick bottoms in things. So the sector has been out of favor. I do think that there is some additional risk. When people talk about it being cheap, they're talking about it based on earnings expectations. And as I mentioned, expectation is that earnings growth for the sector is up 30–40% in the second half. I think you have to start to question that at this point, given what we're hearing out of China and given what we're hearing out of machinery companies. So I think it's too early. And we have in our portfolios, for what it's worth, virtually a zero weight in materials. And it's a group, I think, that tends to have a tough time during the summer, and I think you may have a better opportunity later in the year.
Interesting. From materials, and specifically copper, to a consumer staple company. Here's an email from John, who's in Cambridge. This is on Kraft. Can you explain the mechanics and timing of the Kraft split? They're splitting itself in two quite soon.
So this is a company that we recommended, I think, the last time I came on. And it was for a couple of reasons. First of all, because it's in the right group, the consumer staples group, really in favor. But second, because they are going through the likelihood of a split up. They're going to take the company, they're going to split the grocery business, which is a very stable cash flow generator, from the global snack food business, which is a higher growth business. So the grocery business will likely have a significant dividend attached to it, with some growth rate to it. The snack food business, which I believe is going to be called Mondelez, will be higher growth and will not be a yielder. I think that they're going to give an update in October targeting the end of 2012, the end of this year for the split, and it should be a tax-free deal to just dividend out additional shares in the new company, and they'll both trade independently of one of another.
And do you hold Kraft?
We do own Kraft.
Right.
You know, it's going to grow earnings probably 11 to 12% this year. It yields 3%. And it is in the camp of very stable cash flow generators that the market's looking for right now.
You mentioned you recommended it last time around. And would you hold both pieces of the company once they split?
I would. I think that they both look attractive, and they both have probably different shareholders along the way. But we'll have to see how they trade once they split.
Let's bring it home to Canadian banks. We have Jim on the line in Whitefish, Ontario. Hi, Jim.
Hi, Mark. David, I've owned Royal Bank. I bought the January $50 call and been buying the $48 puts to be put to me. What's your opinion of Royal Bank? Thank you.
Right. So, Jim, just starting from the sector, at the sector level, we really come at this top down to begin with. We have a very light weighting in banks. We actually took a little bit of a crack at the banks in May and fairly quickly got stopped out. I think that the group as a whole is under multiple pressure, that you're seeing multiple contraction in financials as a group. The Canadian banks are arguably higher quality than many other banks globally, and probably within the banking sector in Canada, Royal Bank would be one of the best. The only problem with Royal is that they have a very high capital markets exposure. And we know that margins and revenues in capital markets businesses, investment banking and trading are really under pressure. So I think that, you know, you're going to get the dividend. Probably dividend growth is going to be a little bit less than what people are used to as we go along here. And I don't see the financials leading the market at this point. They probably will muddle along. You're not going to get hurt too badly, but I just don't think that you're going to have big upside in it in the near term.
Which is your best of breed right now, your favorite Canadian bank?
It really depends what you're looking for. I think probably if I had to pick one, probably TD, because they're doing a good job in the U.S. market. They're gaining market share. If you wanted international, it would probably be Scotia, but I'm not sure now is the time to push hard on the international theme.
And there's a look at TD, down 8 cents today to 79.53. Back to materials. We have Gary on the line in BC. He's got a question about a big Canadian miner. Go ahead, Gary.
Good afternoon, guys. David, what do you think of Teck Resources at this level? Do you say is a buy, or do you, again, as you said earlier about the commodities, that there'll be more of a downside? Thank you,
Gary. I don't like to be bearish. I'm generally an optimist, but given the way the group's behaving, it's one that I would stay away from. Frankly, we run a long short fund. We're short Rio, and we're short BHP. We're short Cliff Resources. So I think that it's just not time. The oil sands producers aren't doing so well. The copper folks, the zinc folks aren't doing so well. Coal stocks are not performing well. And really, you're buying a call on commodity prices. And at this point, you're hoping that they get turned around in the near term. And I'm not prepared to make that bet at this point.
No, and as you said, you've got a zero weighting in materials. And as you said on previous occasions here, you like to wait to see a bit of momentum.
Yeah, we'd like to see a turn. Given the fact that the S&P, for instance, trading well above the lows from last October, November, and then you go back and look at the material stocks, they're basically trading back at the lows. It tells you it's one of the weaker performing groups in the market, and it's also the one that can get hurt quite badly. So we've seen, if you take the commodity stocks as a whole, you saw a high at the end of 2010, then they pulled back. They had a rally in 2011 to a lower high. They pulled back to a lower low. Now they've rallied to in January, February this year, another lower high. So I think that they've broken the 3-year uptrend that they had in place from 2009. I just avoid the group.
All right, David, let's take a short break. We'll come right back. More calls and emails for you on North American large caps after this.